Welcome to Iron Financial. This is the place where we forge stronger portfolios by putting market narratives to the test. Today, we're putting on the hard hats. We're grabbing the blueprints for Grainger, ticker GWW. Now, this industrial supplier just dropped an earnings report and some future guidance that has Wall Street buzzing. But the big question we're here to answer today is pretty simple. Are we looking at a solid steel foundation for some serious future growth, or is this whole thing just a cleverly disguised trap for investors? We're going to break down every number, we're going to inspect the framework, and we're going to figure out if this is a structure that's worth building a position on. All right, let's get to work.
So here's how we're going to tackle this. You can think of it like a full structural inspection. First, we're going to lay out the shocking new blueprint that management just revealed for 2026. Then, we'll start forging the bull case, piece by piece with hard cold data. But hey, no structure is ever perfect, so our skeptic is going to jump in and start inspecting for cracks in that very foundation. We're going to zero in on a huge pressure point, the margin squeeze. After that, we'll look at the growth engines management claims they're firing up. And finally, we will weigh all the evidence and give you the final Iron Financial verdict.
Okay, let's dive right into this thing. When a company lays out its plans for the next year, what are we looking for? We're looking for strength, we're looking for confidence, and a really clear path forward. Well, what Grainger just delivered, it wasn't just a plan, it was a flat-out declaration. They unveiled guidance for fiscal year 2026 that you can only really describe as a shocking new blueprint. It's almost like they're planning to build a skyscraper on a street where everybody else is just planning a one-story house. So let's look at the raw specs.
Now take a good look at this slide, because what's really fascinating here is the sheer power of these numbers. Start with the revenue guidance. We're talking up to $19.1 billion. Now look all the way over to the right, that VS consensus column. That is a solid 4 to 7% higher than what Wall Street was even dreaming of. That's a strong beat. But the real story, the absolute knockout punch, is on the bottom line. Look at that diluted earnings per share. Management is guiding to a range between 42 and nearly 45 bucks a share. The consensus on the street, it was sitting below 40. Now look at that VS consensus column one more time. We are talking about 7 to 13% higher than expectations. Folks, that is not a beat. That is a demolition. In this kind of economy where most companies are being super cautious, a beat of that magnitude is a massive, massive signal of incredible operational strength and just pure management confidence. They're also projecting stronger operating margins, expanding them by up to 90 basis points, when, let's be honest, a lot of their competitors are just fighting to stay flat. This is the blueprint they handed to the market. It is bold, it is aggressive, and on paper, it looks like an absolute fortress.
Whoa, hold on a minute. Let me just jump in here. The numbers on the slide, they're one thing. But we're here to check the structural integrity, aren't we? That blueprint? Sure, it looks fantastic. But what if the architect himself sounds a little nervous? The CEO's tone on the earnings call was, let's just say, less than thrilled. And you just mentioned margin expansion for the full year, but we're hearing whispers about margin pressure in the short term. So my question is this blueprint a real vision of the future, or is it just a fantasy drawing with some pretty serious design flaws that could make the whole thing just fall apart? Are we absolutely sure we're not just looking at a bunch of hype?
That's a fair challenge. A totally fair challenge. A blueprint is only as good as the materials and the momentum behind it. So let's move past the projections for a minute and start forging this bull case with some cold, hard steel. We're going to lay down the evidence, brick by brick, that shows this isn't just some plan on paper. It's a project that's already well underway, and it's being built with the strongest materials out there. Let's start with the momentum they have right now.
And this right here, this proves the point. The fiscal year didn't just start off okay, it absolutely launched. We're talking 10% plus daily organic growth in January. Now, this isn't a forecast, this isn't some wild guess. This is a hard number from the very first month of the year. To put that into perspective for you, a lot of industrial suppliers out there are struggling to post any positive growth at all right now. They're talking about a slow start, about macro uncertainty. Meanwhile, Grainger is already posting double-digit growth. This is the engine just firing on all cylinders right out of the gate, and it's what makes a 13% earnings beat look not just possible, but actually plausible. Now, management did mention a little tailwind from a competitor's outage in Japan, but they were really clear that the strength was broad-based. This is just proof of powerful execution.
Okay, now let's talk about the actual framework that's holding this entire operation up. What happens if the economy hits a rough patch? Well, a weak structure, it buckles under pressure. A strong one, it endures. Grainger's balance sheet isn't just strong, it is an absolute fortress. Their leverage, it's rock bottom. They're not drowning in debt like so many other companies. They have over $1.8 billion in available liquidity, which in financial terms is like having a massive war chest ready for anything. And look at those credit ratings.
A+ from S&P, A2 from Moody's. That is a stamp of approval from the toughest inspectors on the planet. It means they can borrow cheaply, they can invest with confidence, and they can weather just about any economic storm without even breaking a sweat. This is the steel skeleton that lets them build higher and faster than all their competition.
Strong operations and a fortress balance sheet are great, but what does it all mean for the owners of the company? The shareholders. Well, here's the crucial point. Management is putting its money where its mouth is. Just look at this chart. The amount of cash being returned to shareholders isn't just growing, it is exploding. From $1.2 billion in 2022 to over $2.2 billion in just the last 12 months. That is an incredible acceleration. This isn't a company that's hoarding cash or making dumb acquisitions. No, it's a disciplined machine, taking its profits and handing them directly back to investors. This isn't just a number on a chart. This is real cash in your pocket as an investor, through dividends and share buybacks. This is exactly how you build long-term trust and real value.
And, that commitment to shareholders, it isn't anything new. Grainger is what's known as a dividend monarch. And that is a rare title, folks, even more prestigious than a dividend aristocrat. It means this is a company that has been consistently raising its dividend for over 50 consecutive years. Just think about that for a second. Through the crazy inflation of the 70s, the dot-com bust, the 2008 financial crisis, the pandemic, through all of it, Grainger has not only paid its dividend, it has increased it year in and year out. This speaks to an incredibly durable business model and a management culture that puts shareholder returns above pretty much everything else. This isn't some speculative growth story. It's a bedrock of pure reliability. Okay, you've laid out a very compelling case. I'll give you that. The momentum is real, the balance sheet is a fortress, and yeah, they reward shareholders. It's a shiny, very impressive structure. But a good inspector, they don't just stand back and admire the facade. They take out the magnifying glass and they look for the hairline fractures, the little signs of stress that could lead to much bigger problems down the road. It is time to stress test this bull case and see if we can find any cracks in that foundation. And the very first crack I see comes straight from the mouth of the CEO himself, D.G. Macpherson. This is what he said on the earnings call when someone asked him about his conversations with customers. He said, "Generally, the mood is okay, but not expecting huge market growth." Now, just let that sink in. The company's own guidance is predicting a massive acceleration in their earnings, yet the CEO is telling us his customers are not seeing huge market growth. There is a major disconnect here. How can you possibly project these blockbuster results when your own intel from the field suggests the market is just okay? It really makes me question where all this incredible growth is supposed to come from if it's not from a booming market.
So this slide here, it really just lays out the fundamental conflict perfectly. On one hand, you've got the guidance, the spreadsheet, which paints this picture of incredible strength and optimism, just blowing past every single Wall Street estimate. And on the other hand, you have the tone from the top, the narrative, which sounds cautious, measured, and frankly a little bit bearish on the overall market. So which is it? As an investor, which story are you supposed to believe? And more importantly, what does this conflict mean for the stock's future? When the blueprint and the builder are telling you two completely different stories, that is a major, major red flag.
And here is a crack that you can actually measure. The entire bull case seems to hinge on that explosive 10% growth they saw in January. But if business is booming like that, profits should be too, right? So can someone explain to me why management guided for gross margins to actually fall in the first quarter compared to the end of last year? This is completely counterintuitive. It's like a construction crew working overtime but getting paid less per hour. Stronger sales should lead to better leverage and higher margins, not lower ones. This is a specific, data-driven anomaly that just does not fit the bullish story. It suggests there's a pressure point somewhere in the system that we need to look at very, very closely.
That is an excellent point, and it's one that absolutely needs to be addressed. That sequential margin decline is a critical piece of this entire puzzle. It's a legitimate concern, but our job here is to figure out if it's a deep structural flaw or just a superficial issue. So let's break down exactly what is causing this temporary margin squeeze. Management was actually very transparent about this, and the reasons are not nearly as alarming as they might seem at first. These are manageable pressures, not some kind of foundational failure.
Okay, let's get into the nitty-gritty. There are three main things hitting margins in Q1. First, you have these LIFO headwinds. Now, don't let the accounting jargon scare you. Think of it like this. It's a way of accounting for inventory. It basically means they are booking the cost of their newest, most expensive inventory first, which can make profit margins look a little smaller on paper in the short term, especially with tariff costs. It's an accounting thing, not an operations thing. Second, there's a small 20 basis point drag from their annual sales meeting. This is a one-time event that just has to do with the timing of some supplier rebates. It's temporary and it reverses.
And third, there is some pressure on the private label brands because tariffs have made some competitors' products a bit cheaper. So when you actually look at the causes, they're specific, they're understood, and for the most part, they're temporary.
So how does a company fight back against these kinds of cost pressures? Well, the most powerful weapon in any company's arsenal is its pricing power, and Grainger is wielding it very effectively. Embedded in their full-year guidance is a price increase of more than 3%. That is a significant hike. They are not just sitting back and absorbing higher costs, they are flexing their muscles and passing them right on to the customer to protect and even expand their profitability over the course of the full year. This is the counterpunch to that Q1 pressure.
And this quote right here, this gets to the very heart of their market position. The Skeptic asks, can they really get away with a 3% price hike? Well, management talked about this directly. They said they haven't seen tremendous pushback from customers. Now, this is a crucial piece of information. It tells you that Grainger's customers rely on them. They value the service, the product being in stock, and the reliability more than they're going to argue over a few percentage points on price. This is the very definition of a competitive moat. It's what allows them to navigate these margin pressures and protect their bottom line when their weaker competitors simply can't.
All right, so we've addressed the immediate concerns. We've shown the foundation is sound and those near-term pressures are manageable. Now, let's look to the future. A strong company doesn't just weather storms, it builds for the future. You see, that cautious tone from the CEO, it wasn't about the company's performance, it was about the overall market. Grainger's strategy isn't to just ride the market's waves, it's to build its own growth engines to actively go out and take market share no matter what the economic backdrop looks like.
And here they are. These are the 5 strategic pillars management is using to construct their future growth, and it's a really comprehensive plan. Number 1, merchandising. Basically, giving customers more reasons to buy from them and only them. 2, marketing excellence, reaching the right people with the right message. 3, seller effectiveness, turning their sales team into an unbeatable competitive weapon. 4, supply chain advantage, using their massive scale to deliver faster and more reliably than anyone. And 5, technology and analytics, using data to outsmart the competition at every turn. This is not a company that's just hoping for growth. This is a company with a deliberate, multi-pronged strategy to go out and capture it. And you know, this isn't just a bunch of corporate jargon on a slide. Let's look at that merchandising pillar in action. In 2025, Grainger added over 85,000 net new SKUs, that's unique products, to their catalog. That is the largest single-year expansion in nearly a decade. They're moving aggressively into new areas like products for data centers and factory automation. So what does this actually mean? It means they are becoming the one-stop shop for more and more customers, capturing a bigger slice of their total spending. Every single new SKU is another reason for a customer to choose Grainger over a competitor. This is how you systematically go out and take market share.
So, we have laid out the blueprint, we have forged the bull case, and we have inspected it for cracks. We've pressure tested the margins, and we've examined the engines for future growth. We have weighed the evidence from absolutely every angle. So now it is time to step back, look at the entire structure, and deliver the final iron financial verdict. This slide really just sums it all up, doesn't it? The bull case, the steel foundation. It's built on that absolutely blockbuster guidance, the incredibly powerful start to the year, a true fortress of a balance sheet, and just massive returns to shareholders. These are pillars of solid steel. On the other side, you've got the bear case, the potential cracks. And I'll admit, that disconnect between the CEO's cautious tone and the blowout numbers, it gave me pause. That's a legitimate red flag, and that sequential Q1 margin decline, it needed a very, very clear explanation. But when you really break down the reasons for that margin dip, they seem contained and temporary, mostly just accounting noise, not a fundamental problem with the business. And that pricing power seems very, very real. It really is the answer to a lot of those concerns.
The verdict is in. After inspecting every single beam and rivet, our final conclusion is that Grainger is a fortress, and it is built to withstand the storm. The bullish evidence is overwhelming, and it's based on hard numbers and a proven track record. The bearish concerns, while valid to bring up, appear to be superficial. The cracks are not in the foundation. They are minor blemishes on the facade, totally explainable and completely manageable. That cautious CEO tone, it seems less like a warning about the company itself and more like a prudent assessment of a volatile macro environment, an environment where a strong company like Grainger is actually built to outperform. The structural integrity is absolutely sound. So that brings us to the final question, the one you really need to ask yourself. We've handed you the analysis, we've confirmed the integrity of the foundation. The blueprint for powerful growth has been laid out for everyone to see, yet that cautious narrative might still be confusing some investors out there. So the question is this an opportunity? Is now the time to start laying a foundation for a position?
before the rest of the market fully deciphers this blueprint and the price finally reflects the fortress that we see today? That's a question for you and your portfolio to decide. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.